What's up, everybody? It's Friday, yeah. Saturday, something. Nah, it's Friday, yeah. It's another Fresh CFO Friday, everybody. Hope your week is going well. My week has been good. I've been traveling this week. I was in Atlanta for a couple days, which is a good change of pace because Atlanta, compared to Indiana, Atlanta was like 65 degrees. It was warm outside. I was walking to the gym. I was eating some good food, and then you come back to Indiana. And when I was coming back from from Atlanta to Indiana, the weather was raining, yuck, and it was back to the gray, gloomy skies. And it's 5 o'clock, and it feels like midnight. So, yeah, that was not a fun time. But we're gonna give a couple seconds for people to come in. I was supposed to be having "Cash Rules Everything Around Me" by Wu-Tang Clan and P Diddy's song "All About the Benjamins," which were bangers, right? Like those were some good songs back then. It's funny to say back then because that was like early '90s or late '90s when those songs came out. But yeah, we'll start here in a minute or so. Let me know how your week is going. Drop it in the chat below. I can see it. How's your week? How's your Friday? And yeah, let me know. Cool. Well, we'll go ahead and get started. Thank you. Welcome to another Fresh CFO Friday. Today, you'll learn all about the important topic of cash, right? Today, we're going to talk about the important topic of cash for all businesses and finance professionals. And for all of those new to the channel, hi, I'm Chris Ortega, CEO of Fresh FP&A, and we help businesses transform and scale their finance organization by providing fractional CFO and advisory services. Fresh FP&A has a proven track record of transforming and scaling high growth businesses all over the world. We're your strategic partner and your finance partner to help you navigate uncertainty and continue to scale your finance organization. So, on this channel, everything we talk about is everything of finance, FP&A, CFO, fractional CFO related. And today, I'm excited to talk to you everything about cash, right? So, looking at the macro environment right now, right? I remember last year I was working with a organization called Neuro Group, and we were talking. I remember I was like, man, cash. I always say this phrase like, profits are a dream, but cash is a reality. And you're starting to see that become a reality for a lot of businesses, right? Unfortunately, in the macro environment, when you look at all the different layoffs that are happening in the tech space, it's sadly like every day it's like I look on my LinkedIn or I look on Twitter or get an update that some other companies like releasing 5 to 7 to 10 to 20% of their workforce, and you're starting to see a lot of businesses that are preparing for the other macro factor, which is this global market that we're seeing right now in terms of the recession. Is the US going into recession? Is there not going into recession? There's a lot of topic around that. So one of the most important metrics that every fractional CFO, that every CFO, that every finance professional should be talking about is cash flow. And looking back over my experience in high growth SaaS businesses and high growth just businesses overall, that has always been for me like one of the number one things, whether we're going through like a recession or whether we're going through like a prosperity kind of economic time. Cash has always been something that is like top of mind. It's something even in leading Fresh FP&A, something I think about with my team as well too, is how we're measuring cash, how we're optimizing cash. So those are just some macro indicators of why cash flow is so important right now. Like if you pop open LinkedIn or you pop open Twitter or you look at the news, right? Like cash flow optimization and making sure that you're looking at your cash spend, making sure that you're measuring it right. Cash is everything now. Cash is king, cash is queen, whatever you want to name it. Cash is like the most important topic right now. So that's why it's important. How can you optimize it, right? I think cash optimization. One of the topics I want to talk to a little bit about that is, when you look at the kind of traditional ways of what a lot of CFOs have done, what a lot of probably fractional CFOs are advising, and a lot of things that I've done throughout my career in terms of optimizing cash is you look at it in like pillars, right? When you look at like the overall business, right? Most of your cash is going to be tied up in your people, right? It's going to be tied up in that. Whether you're SMB or enterprise level company, that's going to be one of your biggest cash outlays, right? And the traditional mindset from most CFOs and most finance professionals is like, hey, if we're running into cash issues, like let's start with this element. I fundamentally disagree with that, right? People are, and I posted a chat on this, and this is my philosophy, right? I can't speak for the overall CFOs, but people are the most valuable asset to every organization, right? And I'm not saying that in my career I haven't had to make the tough calls of having layoffs or having reductions or foregoing bonuses or foregoing new, like you have to make those decisions, but that shouldn't be like the first place you start, right? We should have other strategies. We should have other tactics. And that's what we're going to go through today. We're going to go through some metrics. Really, I'm going to give you a deep dive of a lot of different metrics, give you the formulas, give you the how to measure them, what you should be talking about. We're going to talk about that. And then also, I'm going to give you some strategies that you can go implement that can make an immediate impact on your cash optimization and strategies that you can have. And most of those, I'm going to tell you, don't include of laying off people, right? Now, listen, I'm not saying that that's not an option, and but it shouldn't be the first option. Like of all the list of strategies and tactics that you can implement to improve your cash position, improve your burn rate, improve your cash runway, right? Like people should be like the very last. Like you've exhausted this entire list of tactics. That is when you should like it should be the first one. So I think that's really, really important for us to think about. So again, everything we're going to talk about application. I'm going to give you some use cases of where I've done it, and I won't share client specific detail, but I'll share some things we work with clients on to help them around it, to help them manage and optimize their cash. So let's get into the metrics. One of the first ones that you need to have is like, let me look to all my accountants out there. You're gonna hate me for this, right? You're gonna be like, Chris, former CPA, pop you on the with the ruler or the with your green visor, and you're coming out with your 10 key calculator, and you're throwing it at me, right? Stop looking at the statement of cash flows. Like, yes, it is one of the most important financial statements, but it does not give you like it's the indirect version of looking at the statement of cash flows, right? Look at the direct statement, the direct, right? And what the direct method is, that is the change in your bank account, right? So analogy, I think of like the way you should be thinking about cash, and the way you should be positioning this to your client is you got a bank balance at the beginning of the month of $100. Your bank balance at the end of the month is $90. Your cash burn is $10. You have burned cash in between in that month over month, right? That's hard money you have access to. The disagreement and where my CPAs and my IFRS and my number gap US gap IFRS police would get on me is like when you look at the statement of cash flows as it is presented indirectly, right? You've got all these accounting things you got to take off, right? You got to add back depreciation because that's not really a cash impact. You got to look at the change in accounts payable. Like there's so much like accounting principles and methodologies that goes into that statement of cash flow that really doesn't take you from that simple, easy. You had at the beginning of the bank, you had $100. At the end of the month, you had $90, right? That is simplistically how you should be looking at your cash, right? The first metric, cash burn, right? Kind of talked about that. What that is the cash you get in, right? So this could be your collections. This is the money you get from your customers. All the cash on a weekly, monthly that you get in from the business, right? Minus all the cash that you send out of the business, right? That's paying your people, that's your vendors, that's that could be rent, other things that you're paying, other OpEx things you're paying. That is the true measure of that cash burn. And getting back to that example that I just mentioned, that is the $100 at the beginning of the month, the $90 at the end. You've got cash coming in, you have a net burn of $10, right? You go from 100 to 90. You had a net burn. That net burn is cash in minus all your cash out. That's what produces that negative 10. So important. I remember, back in leading finance organizations, right? Like that was like I was like, when I want to measure cash, this is how I'm going to look at it. We're going to take the direct methodology around cash changes in bank accounts. I want to know hard numbers around it. So that's the first metric. The second one you want to be measuring specifically is, and obviously, before I move to the second metric, cash burn. Best case, you want that to be, and you can also like, and I want to go like depth into this, right? There's ways to look at cash burn on like a weekly basis. There's ways to look at it a monthly basis. There's a way to look at a quarterly basis, semi-annual, year over year. You should have a lot of different ways that you're dissecting your cash burn. We're gonna get into some other metrics that even you can get even more laser focused in terms of how you're looking at that burn, right? But you want that best case, like if you want that to be positive, right? You don't want to be burning money. You actually want to be your inflows and your outflows actually producing a positive, right? But if you are burning money, you want to make sure that you're keeping that within a relevant range, right? And you'll have picks and cycles with it. Sometimes what I see is like in high growth businesses, typically later on in the year, if you're overachieving on your revenue targets, you're going to start to see that burn increase because maybe you're paying out more commissions, maybe you're paying out bonuses. But you definitely want to make sure you have the handle around it. And that's honestly the number one thing, right? The number two metric that you should be measuring around cash is your cash runway. Think about that. Okay, so going back to the example I mentioned, you got that $100 in the bank, right? Right? You got that $100 in the bank. You got that $90 at the end of the month, right? 100 minus 90, you went down $10, right? So the first metric, your cash burn is 10, right? You take 90 divided by 10, that says that if you keep that same cash burn at $10 a month, you have a runway of 9 months of cash that you have, right? That's how you measure cash runway, right? Beginning balance, ending balance, whatever that net difference is, divide that by the ending amount of cash. That is the amount of runway you have. Why, tying back to what I mentioned earlier, why do you see a lot of these organizations making these layoffs and these reductions? Honestly, this is me being wild, and I'm gonna be, you know what? I'm gonna be really honest about this. I can understand when you look at a company, I won't say the name of these companies, right? Because I probably have people, and I don't want that to honestly, I don't want that to bite me in the ass later. So just being honest, right? But I look at some of these companies that are making 5 to 7% reductions in their people, right? And a lot of the reasons they have around that is like, oh man, during the pandemic, we overhired and we need a right size, right? We need to right size our expense. We need to right size our business and make sure we have a sufficient amount of cash. We need to have the right size of cash, right? And then you see the decision being made, right? And then you go over to the good old balance sheet, right? Right? And you look at their cash and cash equivalents, maybe in their 10K or 10Q or their most recent filings. And I'm like, make it make sense why you have billions of dollars. You have billions. Like no cap. You have billions of cash sitting on your balance sheet, right? Billions, right? Billions of cash. So unless you're burning like $1 billion a month, you've got like sufficient amount of cash runway to do this, right? Now, get it. Some people may say, "Hey, Chris, well, you got to look at the expectations they have to have. They have investors, Wall Street estimates and things like that." I get it, right? But typically, you're making that decision because you don't have you want to get the right amount of runway, right? The right amount, the gold standard of runway, I would say right now, what I advise a lot of clients on is you want at least 24 months of cash runway on your balance sheet and cash available right now, or liquidity that you can access for at least the next 2 years, right? That is 24 months. You want to have at least that runway at a minimum, right? And the way to measure that is looking at that ending balance of whatever your cash balance is divided by your burn rate. That's how you measure that. The third metric that I want to give you that is really, really important, and we'll start diving into some of those cash burn. I call it the collections velocity, right? Collections velocity is and a higher level, like accountants look at this. I look at it collections velocity, accounts, and one of the common like metrics that you'll see out there is day sales outstanding, right? Which takes in, the average AR that you see, total sales during that period, and then you divide it by the number of days, right? Which is more of an accounting metric. I say collection velocity because that's looking at when you getting a payment from a customer and when was that due date, right? So, for example, if you got payment from a customer on February 1st, right? That is the payment date, February 1st, but that invoice was actually due on, let's call it December 1st, right? That collection velocity between the payment date and the invoice due date is 60 days, right? Like you had a 60-day velocity before you turned over that individual accounts receivable, right? And this is what I'm inviting. Like you're getting into the details. Like you're pulling AR aging reports, you're pulling the AR data, you're looking at that for the last 12, 18, 6, 3 months. Like you're getting into the details, right? But you want that collection velocity. You want to really, really have a sharp cadence around that. How's your follow up? How's your dunning letter? How are you leveraging technology to automate a lot of those different things, right? How are you making it easier for a customer to pay you? One of the biggest things I recommend for a lot of my clients that I work with is like they don't even have like most of the time. I don't know why this is still in the US sometimes, but we are big into checks, right? I have my European teammate and they're like, Chris, everything is through like wires or ACHs. If somebody writes a check, it's like the end of the world. But we still love our checks here, which is going to get into another metric to measure. But we love our checks here, right? And a client, the check, mobile depositing it. It was taking like a 4 to 5 day timeline before that would actually get into the bank, right? One of the solutions that we recommended from them is getting a direct lockbox, right? That cash was instantly available like that day. It was sent there, one place for it to go. So that collections velocity, you want to decrease that, right? If you're looking at on averages of all your invoices and you're looking at the data and you say on average, the payment date versus the invoice due date on average is like you know, call it like 45 to 60 days. That's a 2 month timeline before you're getting that cash in, right? The gold standard is you want to get that down to at least 30 days, right? Like that's good. The best, you want to get that down to 15 days, right? You want to get that collection velocity between the payment date and invoice due date of all your invoices, 15 days. Get a 2 week period where you're condensing that down, right? That's the fourth metric you want to measure. The fifth one, kind of the reverse of collection velocity and day sales outstanding is going to be what I call AP flow, right? If you've been part of any business, you have floated your AP vendors, right? And basically what AP float is, it's the reverse of that collections velocity, right? And it's looking at it from the vendors that you pay, right? So you take the same payment date that you paid the vendor and when that invoice due date is on the vendor side, right? And you minus those out, and you want that like if you're paying, and this is we'll get into more details too, right? Like because there's certain like discretionary, there's certain vendors that you have to payment to. Here's certain ones you can float. You have to have that level of expertise to do that. But you want that if you're paying that like an AP, right, in a 15-day, think about it, right? Let's look at the math. If your collection velocity is like 60 days, right, that means it's taking 2 months for you to get a payment on a due date, right? And your AP velocity, your AP float is 15 days. That means from the payment date and the invoice due date of that vendor invoice, you're paying in 15 days. It's not over. You're not getting the cash. You're paying too fast versus the cash that you're getting in, right? The optimum place that you want is like you want a collection velocity of like 30 to 15 days. You're getting that cash in faster, right? Keep the float. I like to push people and like, man, 30 is like a minimum, 45, but like pushing out to 60, that is, and a lot of times you can do that with key vendor relationships, right? Like you can go and renegotiate and say, look, we want to stay with you. We want to update the payment terms. A lot of times it's cadence that you can have around that, but you want to make sure you're balancing that collection velocity. You want that to be shorter amount of days of cash coming in, and your AP float, you want that to be a longer. You're getting more cash in, you're letting that cash last a lot longer, right? So you're extending out that runway, right? And the two metrics around that from like an accounting perspective, right? You got day sales outstanding, which marries up to collection velocity. And then you got days period outstanding, days payable outstanding, which matches up with that AP flow, which are common terms that you'll kind of hear. Um, the other metric is like you want to take that cash burn, which is the first one, break that down a couple levels, right? Look at your cash outlay, right? Like what is discretionary and what is non-discretionary, right? For example, a non-discretionary cash outflow are going to be paying your people, right? Like you can't like people are doing work. You don't want to make that where it's like and yes, people may ask, I have been in situations where I didn't make payroll. Yep, I've been there, and it was the worst. It was one of the worst experiences I've ever had where I did not balance outright. And shout out to Silicon Valley Bank for looking out. And that was a tough experience not meeting payroll. But I share that because like that would be a form of looking at your cash outlays that is non-discretionary, right? You can't have discretion if you're paying people or not, right? But you can look at certain vendors and say, hey, like who are the discretionary ones? Identify that vendor list, look at that AP vendor list, look at the frequency around that, and say, okay, which one of these can we either renegotiate a contract agreement that we have, or we have some discretion that we can float a little bit more, right? So for me, like I would say like those are the top ones. And you can get into so much detail like on the collection velocity side. One thing I say with clients is like we sit down and we do a full mapping of like how all of that AR detail looks like, right? Because we want to have a vision of increasing our cash runway or reducing our burn. That's the vision, right? What is the strategy that we go in and do that, right? We look at collection velocity. What are some of the tactics we want to use, right? What is the milestone that we want to reach, right? So if we want to go from, a collection velocity of 60 down to 45, do we want to do that in 30 days? Do we want to do that in 90 days? Do we want to do that in 6 months? And also, what is the metric that we're going to measure success on that? Collection velocity. That is that entire vision, strategy, tactic, metric, milestone. That's what you should be doing, right? Oh, and by the way, if you want to know, like that's how you strategically think about this stuff, right? That's how you go back through it and you tie into the details, right? So to me, those would be kind of like the top metrics, right? You got other ones out there. You got AR turnover, right? That looks at how quickly you're turning over your AR. You're looking at, day. I like the comment in the chat. Day sales, days of cash on hand, right? You got that one. You got the current ratio. You got a lot of those different things. But to me, like I like those, and I think they're good metrics, but these metrics that I'm giving you are getting into the cash. It's getting into that direct kind of methodology of terms of looking at cash. It's getting directly in it. How are you taking $1 and how's that dollar being either in the business or out of the business versus like some of the larger like accounting kind of things that could go into it, right? And it's good to have a balance, right? I advise clients like if you're already measuring DSO, if you're already measuring days payable outstanding, if you're already looking at days cash on hand, if you're already looking at accounts receivable turnover, AP turnover, if you're looking at those things already, current ratio, all those different things, right? It's great, but add some of these that give you that direct cash in and out insight. So what are some strategies? So I got a whole list of these. I'm excited to go through these. One of the first place, like strategies, and these strategies I'm going to give you are things that I've done and strategies that I recommend. And all of these strategies, every one of these strategies is not about laying people off. So getting back to my point I mentioned earlier, right? What us fresh CFOs are doing, right? Right? What us fresh bring in the fresh perspective in the finance, bring in that fresh attitude, bring in that fresh mindset, right? Is like, don't go to the first place. That's your most valuable asset to make an impact. Go through this exact list, right? First place you should start contract management process, right? One of the best ways that you can make sure on cash burn and that cash in, make sure that you're enabling your sales organization to have the right contract that you want to be sold, right? I remember working at a SaaS business and our contracts were all over the place. It was And I've worked at a lot of SaaS businesses, and I see a lot of clients that have their contracts all over the place, right? Some of them are the languages is all different, the payment terms are all done, the different formats of it that they've had, and like some of the times I looked at some of these contracts and I'm like, you look at it with a client or a customer, I'm like, how would a customer even understand like when you're going to invoice them, when do they need to pay, when does RevRec start, like all of these things around it, like common things that are just like this is impossible to make sense out of, right? Standardize that process, enable that sales group to make sure they're selling the actual ideal contract that you want, right? Maybe it's a multi-year agreement, maybe it's not monthly. Monthly via credit card every month is probably, you get that money every month but you minus out the 3%, right? Like it's a good avenue, but if you have a lot of customers on that, right, it's a very churn and cyclically, like very volatile kind of place, right? Because then it's just like, hey, I don't like it for a month, I can cancel it out, right? Standardize that contract management process. Make sure your sales team is enabled to know the right contract that they should sell. Why is it the right contract for them to sell? And then also the third piece of it strategically to think about, incentivize your sales group to sell the right contract. For example, a lot of times I advise my clients, I'm like, look, if you're managing that, tie accelerators or commissionable items to, if you sell a multi-year agreement, right, you get extra amount on top of your commissions. If you sell a annual payment in advance contract, right, you get an extra kicker on your bonus, right? That's with them, right? You're understanding and you're giving them to say, here's the ideal contract. And oh, by the way, you're incentivized to sell this ideal contract, right? In leading SaaS companies and finance organizations, right? When you have the carrot and you're leading with it, they're going to sell more of that, right? Great place to start. The second one, and you've seen it before. I've done some great work with some great organizations around this. Optimizing your SaaS spend, right? Usually, technology is one of the most. It's probably like people from an. I'm looking at it from an OpEx perspective, right? People are going to be probably your 50 to 70% of all of your expenses, and probably the same thing for cash as well. Technology is going to be another element of that, right? So, really getting a strategy, really getting a strategy around how you're managing your technology spend. For example, you see a lot of organizations that during the pandemic, it was like some organizations that were already remote. It wasn't as a big of a shift to get the technology to enable the workforce of what they needed. But a lot of those organizations that were not ready for that remote and not didn't have the technology infrastructure, a lot of small SMB like SaaS companies, they were like, hey, like, yeah, get whatever technology that you need to be successful. Like, yeah, like go get this, go get Slack and go use Teams and go use Zoom. Now you look across the business now, right? And you got all these like similar SaaS solutions, right? And oh, the other thing, right? Nobody knows who owns the contract. Where's the contracts at? Who signed it? Maybe somebody signed the contract and they're no longer at the company, right? Like I've seen it so many different times. Or they sign a contract, it's on this the founder's credit card, and it just like automatically renews, and you're like, what's this $80,000 charge that automatically renews and paid out of credit card, right? Get your hands around that, right? There's so many great solutions out there. I'll drop a link in the description of this video of some of those great SaaS solutions that I've worked with that really get you around managing that entire SaaS spend. You can make some immediate impacts. You get, guaranteed pricing on a lot of them. A lot of them guarantee you savings. You get best in pricing. You actually get a handle around all of the different technologies and contracts that you have. Because one thing is like, and I've seen it. I've seen, and I don't like saying names. I've seen a very large CRM company that is the largest CRM in the world. Hint, hint. You could probably like figure that out. But you see a lot of these contracts that are just auto renewed, and it's like for maybe 100, 200, 300 licenses, and there's like 60 people using it, right? And of course, that company is not going to go to you and be like, hey, oh, by the way, we got this renewal coming up. And typically in the contracts, right, they'll have that auto renew period of 60 days. So like you're already locked in, and you're by the time you figure it out, you're like, hey, sorry, you're already in the locked in period. So we'll have to look at this next year, right? They're not going to tell you how many people are using it, right? So there's so much like clients that I see that are overpaying for licenses that don't even have the active users using that, right? And they would have never known that. It would have just been auto paid and be like, "Eh, well, I guess they're using 200. I guess this is the right price." And it only went up 5%. Of course, it went up 5% because you were charged like 30% above what you could have been negotiating on earlier on. So you're already getting compounding on that license, right? It's another strategy you can implement. The third one, process optimization, right? Specifically around your AR, right? Specifically around, kind of mentioned this earlier when we talked about that collections velocity, right? Really getting laser focused on your entire AR process, right? And this is where, partnering with the accounting group, or maybe, they don't, if they don't have an accounting group, they're partnering with one of the partners we reference them, right? Because we're not doing the accounting work, right? It's a difference between me and the other. It's the difference between Fresh FP&A and the others is like, we are the strategic finance partner that are guiding the vision, the strategy, the tactics. We're not your accounting partner that's upselling. You know, we're not that, right? We're strategically focused. But process optimization on your AR, AP side, get that standardized. What are the bottlenecks? What are the pain points? What technology that you can be leveraging? How can you automate a lot of that tactical workflow to free up your people to really think strategically about how they're driving bottom line results to cash, right? It's another lever that you can pull that can have an immediate impact. The fourth one, this is a common one, and I kind of stumbled upon this one a couple companies ago. Right, is like really getting laser focused on your prepay balance. Right, prepayments, prepayments is it's one of those like balance sheet accounts. It's one of those asset accounts that you really don't like. Prepayments is like the contra of depreciation, and like you look at it sometimes, you're like prepay gets no love sometimes. I remember being an auditor at Ernst and Young, and we very rarely like tested prepaids. We just tested to make sure like it like the expense side of it and the AP side of it, and it was like right cutoff. I won't go into all the details of what we tested, but really look into that because you can uncover a lot of different places where you can start leveraging, right? Like, for example, if you got a bill that's sitting in a prepaid and it's for an annualized contract, right? And it's like $120,000, right? That's a great opportunity to go look at that contract and say, oh, no, no, no. We're not going to pay this $120,000 right out the gate and amortize it out. We need to go renegotiate this contract to make sure like we find more favorable terms. Maybe you condense it down to quarterly, and you're billed quarterly in that, right? There's so much that in covering that prepay balance where you find instant ways that you can go renegotiate a contract, or if you're proactive in and of it before the contract in and of itself, you're not having to pay that annual payment out or have this. You can have it more structured and more cadence out from a payment perspective. So prepaids are a great avenue, and commonly a lot of people just don't even look into that in terms of ways of optimizing cash, right? Another way that I would say is leveraging credit facilities. So one of the things that, in particularly high growth SaaS businesses, it's a lot difficult if you're a high growth SaaS business to go get like traditional debt financing from like a Chase or like a bigger bank because they don't really like the SaaS model because it's a lot of volatility. It's a lot of volatility, right? There's a lot of metrics in it. But there's one great partner that I've worked with throughout my career. Their name is SaaS Capital. I actually posted about them on the Fresh FP&A business page, so check them out. But they help you provide like credit facilities around tied to your ARR, tied to your net dollar retention rate, tied to some SaaS metrics that you can go actually draw upon. And it's a lot, and they understand like they are like the lender for SaaS based businesses, right? So they understand that piece of it. You can leverage a lot of those facilities, right? Like, say you're in a cash type, but you have a strong net dollar retention rate, you have a low customer churn, your customer lifetime value. A lot of those top line metrics are strong. You can actually leverage that top line performance to actually get instant cash that you can need from a facility perspective. So, another level to pull. This is another good one, cohort revenue acceleration, right? So one of the things in working in SaaS business I was a part of is like your new renewals that are coming up, you may take a discount on those, right? So you'll have lower revenue in that next year. Say for instance, like you have your Q1, there's a group of, I don't know, 50 customers, Q1 of 2024. So like a year from now, right? Their renewals coming up a year from now. But you could give them the option to say, hey, look, if you want to renew with us right now, we'll give you like a 10 to 50% discount if you pay your next renewal now, right? That's a way. Now you're getting a discount on the revenue that you're going to have in the future, which has a maybe a bigger impact. But if you're in a cash strapped business right now and you need cash immediately, like you're like, look, I need cash now. Cash is more important now than I need to worry about it a year from now, right? You can accelerate that cash inside, right? So you get that cash immediately in the business to help you around that burn, maybe extends a runway out a little bit. The customer gets, if they're in a stronger cash position, they can actually leverage a discount. So it's like a win-win across the board. But be careful about leveraging that too much because you can also dip down into your revenue production. And it'll start affecting some of those other cash metrics as you discount that renewal in following years. But again, like if you're in an immediate cash position and you're thinking about, do I lay off people or do I look at some other ways that I just mentioned that we can accelerate cash in the door? These are the things you need to be doing first, right? Another one is, this is one that I've actually like done before as well too. Like when you look at like bonuses and merit increases and a lot of those different things which people are definitely conscious of right now. One unique way, and I've advised clients, and I've actually done this before in high growth SaaS businesses, is one way is like giving that bonus or supplementing it for an equity. Maybe it's an equity option, or maybe it's an RSU that becomes vested at a certain time period, right? You're giving the employee the option that if they want to take that bonus or they want to take that incentive that they're going to get that merit increase, they can leverage that. But then also the people that actually want to take a longer equity stake inside the business, right? And there's a lot of different avenues that you can explore why that's advantageous, right? Valuations increase, your value increases, things around that. But that's a way of managing a lot of those different things. Sometimes for international clients that we work with, you get into like work council laws and like things around that. So it can be complicated. But if you have enough hindsight, right, to leverage and say, maybe instead of paying out, we want to give employees the option that they can take an equity stake in our business that could have longer future value. And for us, it doesn't necessarily mean we're paying out that immediate cash right now, right? So it's a different measuring stick that you can measure on going that could have an impact. Another one for people that are heavily invested in capital expenditures, right? Work with a leasing partner. Like directly work with it. Like, do not go out there and say like, "Oh, we got all this equipment we need to buy. We gotta, we got all these laptops we need to do, and like we need to go spend like $2-3 million of our own money. That's going to be a significant cash outlay, right? That's going to eat into our burn, right? Go find a great leasing partner that you can have and then just get on a leasing schedule. You may pay a little bit more in the longer term, but think about it, right? You're not having to pay $1 to $5 million of immediate cash expenditure, right? That's going to eat into your burn, that's going to eat into your cash runway immediately when you make those purchases, right? Like you go buy that stuff, you were spending dollars, $100 that we said before, $90, right? You're spending that exact cash versus being able to space that cash outlay out, right? You may be spending a little bit more, right, on what your initial investment is going to be. But again, getting back to that holy grail of that 24 months of cash runway, you're able to spend that out and you know what you're going to spend every month, right? You know what that spend is going to be for 24 months, 36 months, or 12-month lease agreements that you want to have. You know exactly what that dollar amount is going to be, right? Versus spending all of that money now and buying all of that equipment. I see this time and time again where CEOs, founders, and business owners they don't even think about that option, right? They just go spend, and I'm like, you could have leased a lot of this stuff and could have had a partner and could have spaced this because could have spaced this cash flow out a lot more over time versus taking the immediate hit. Another one is pausing discretionary spend items, right? The number one discretionary one that you've seen a lot of organization pause was travel, right? Like that was one's like, hey, you don't have to travel. We got all these remote tools. We got, Zoom, we got Slack, we got Microsoft Teams. Leverage those. And you've seen a lot of organizations be successful. They were able to, continue to grow. And CFOs love that because it was like bottom line. People are not traveling, right? A lot of liability, no like travel was reduced. So I think another way that you travel is one of them. Looking at your operational expenses and what are some of those like discretionary items, travel, meals and entertainment, kind of stuff within reason, right? I'm not saying eliminate all of those, but really look at where is your discretionary OpEx that you're having to pay cash on today, whether that's expense reimbursements or travel partners or whatever those cases may be. How can you pause or like limit those? Because those are going to have immediate cash impacts, right? The last one I want to give you, and this is a whole list. You know what? I'm going to make a post out of this, right? Hopefully, somebody doesn't look at my post and be like, "Hey, Chris, this is really great stuff. I'm going to take it from you." That's good too. Like, that's good. It's not bad, but just give me some credit. Like, negotiate your key customer contracts, right? Like, negotiate your rent contracts, your customer contracts, your vendor contracts. Go look at all of those different pieces of it and where do you have leverage that is advantageous for you from a cash flow perspective. Rent is a big one right now, right? Because you have a lot of people that are not going back, and you have a lot of these landlords and commercial business owners that are just like, you come to them and like a lot of times it depends, right? A lot of them are flexible if you've been there. A lot of them like look at the lease agreements and say, take us to court if you want to fight us on it. But a lot of times you can look at those avenues and say, look, can we have some like 1 to 2 year concessions in at least the next 1 to 2 years? Maybe it's like a ramping up rate, maybe it's like a deferral piece of it, but definitely take an opportunity to look at all of those key contracts across your business that have an immediate rent, cash, employee agreements. How can you like the RSU thing that we talked about, vendor agreements? Definitely dive into all of those, right? So that is my list of strategy and mine. And listen, we went through all of those, and not one time did I say lay off a person in all of those different things, right? Right. Like let's take a moment, right? We looked at all of those, and there's tactics and there's milestones, like the whole vision, strategy, tactics, metrics, milestone that you can apply to all these different strategies, right? That we have done for our clients that they had immediate impact on their cash burn and increase their cash runway, right? They've had they've had immediate impact and even giving more value to the organization, right? And none of those was about laying off people. None of them, right? I'm not saying that if you didn't exhaust this whole list and you sit down there as the CFO or the fractional CFO and you're sitting down with the client and say, hey, look, we've exhausted all of these. We're going to have to make the tough decision. Like, we're going to have to make that decision, right? That's a different value proposition than the first one on the list is like, hey, we need 24 months of cash burn. I'll just let's look at the models. Oh, yep, 80% of our cash is tied up to people. Reduce that by 10%. Here's the Excel model to do it. No, 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 no. Don't do that. If there's one takeaway you take away from this video, all you CFOs, all you finance leaders, all you fractional CFOs that are advising your clients, go through this list. Go through all those strategies that you can implement first before you impact the people. Put people before profits. Put people at the center of it. That's the focus. So yeah, that's everything, right? The metrics we kind of went through, we kind of talked about at a high level what's driving this whole cash piece of it. We looked at some great strategies that you can implement. So thank you so much for your time. I hope you enjoyed the video. If you did like this video, make sure to like, comment, subscribe, click the notification bell on our Fresh FP&A YouTube page. That way you don't miss any updates on any future CFO Fridays. And as I always end every video, keep pushing, never settle, and the best is yet to come. Let's get it. Cool. Hey guys, thank you all for being here. Really appreciate it. Chris, this was great. Definitely appreciate these strategies as alternatives. You got it, my man. I'm happy to do that. Thank you so much. Yeah. Thank you so much, everybody. Enjoy the video. Keep pushing. Hope you have a great rest of your week and a great February. And make sure to tune in. We'll have a next one next week. Fresh CFO Fridays. See you, everybody.